Hi, and thanks for tuning in for this quarter's Student in the Market Update. My name is Sean Bjork, and our role is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings program. So same format as prior quarters. Real quick, we only got a handful of slides, and let's see what the markets are doing and have done to wrap up 2024. So looking at 2024, we're going to see that investors are going to have some S&P envy. So what do we mean by that? Taking a look at the slide here, S&P envy, we're bombarded with the S&P as the yardstick or benchmark that the financial media likes to use, that everybody likes to talk about. And when we look at how the S&P 500 did in 2024, we're all going to say, why didn't I just do that? Why wasn't I just in the S&P 500? Why am I in this boring old diversified balanced portfolio, right? So historically, if we look at this, graphic and we see, well, how much of a pullback would the S&P 500 or would there need to be in the S&P 500 for the balanced 60-40 to pull ahead? It turns out not that much, right? So, if we look at the numbers here, the S&P from October of 2022 through November of 2024 was up 67%. The boring old traditional 60-40 portfolio was up 47%. So not too shabby, right? And what would it take in terms of a pullback for the 60-40 to pull ahead? It's 34%, right? So that's a big market move for sure. But in the grand scheme of big market drawdowns, not out of the realm of possibility, right? So I bring this up to try and help answer the question: why would we advocate for a diversified portfolio for retirement plan investors? Well, one, the S&P is wildly concentrated, especially right now. And two, if we look at the next slide and we think, we've covered this in previous editions, but if we look over this 20+ year period that had an amazing tailwind for the S&P 500, the punchline is the diversified portfolio still won the day, right? And so when we think about a diversified portfolio, it just never feels good, right? When the market's down, we still lose money. And when the S&P, when the market does great, we usually trail the S&P or whatever benchmark it is we want to talk about at the time. So, just important to note, right, that there's a reason that the diversified portfolio has served investors incredibly well over long periods of time. And it's really important to think about that and recalibrate our expectations, especially given, the wild run that the S&P 500 has been on in the recent past. So if we think about what's going on the bond side of the equation, let's talk a little bit about the stock bond correlation, right? Historically, stocks zig, bonds zag, right? And what we're seeing here is a historically high number of times that when stocks lost money, bonds have also lost money over the last 13 months. So, historically high correlations. We haven't seen a correlation like this since 1926. And so really important to note, the market does tend to mean revert over time. And when we think about why we own bonds, there's a lot of reasons, but diversification from equities is one of them, right? So if we look in the recent past at some of the big market drawdowns here, we can see that core bonds actually have really done their job over these market corrections, where we really did want to have some protection from some of these big down moves. So important to note that even though it might not feel like it, just like diversification, it might not feel like it in recent history, but historically the role of bonds, they're still performing that role. So, really important. Again, it's easy to lose sight of, what we're doing and why we're doing it as a, long-term investor in our workplace savings program. But important to note that, we want to win more by losing less, right? And we want to be diversified over time, because no one has a crystal ball to tell you which of these asset classes in any given year is going to be the hot hand. So let's wrap up finally and talk a little bit about private markets. This isn't something we generally talk about within defined contribution or workplace savings programs. Individual retirement investors in their IRA accounts can, freely take advantage of some of these private strategies as qualified investors. But in workplace plans, we're starting to hear a lot more talk about private investments within workplace plans. Today, they're allowable inside of broadly diversified vehicles. So think target date funds, managed account solutions, but we're hearing more and more talk of private assets, private equity, private credit, infrastructure, real estate, just private markets in general, because they're making up such a large part of the investable universe today. So, stay tuned. I think this is going to be a topic that we'll be talking more about in future editions. But for now, thanks so much for tuning in. Our goal with this series is to help you make informed and confident decisions within your workplace retirement savings program and beyond. Please don't hesitate to reach out to us if there's anything we can do to help in our role as your workplace plans advisor. And certainly, welcome conversations, both talking about your investments in plan and certainly the opportunity to help with those outside of the plan and beyond. And so thank you so much for taking the time to tune in and become a better student of the market. And I look forward to catching up soon. Thanks. So long.